Right.
that takes a long time. If you're JP Morgan, that takes a long time to get back, right?
Yeah, especially with the deficits. I mean, look, I want like there's you have to understand. I have a bias here. My bias is someone stupid at the table. It's not me, and I have to assume it's not J.P. Morgan. So, but because they're smart, right? But the flip side of that is someone stupid at the table, and the odds are it's the biggest guy at the table. And so I don't know, Scott. And I don't, but the thing, the beautiful thing about this is we don't need to know. Somebody's got a problem. And now it gets into the reality of it. In 2011, when silver spiked, I was trading futures at the time. And from a desk, I was trading future spreads. I was trading these massive spreads. For me, I wasn't a spread trader. I'm more of an options trader, an option spread trader. But I saw an aberration. I saw the spreads were screwed up. So I said, I'm going to trade a butterfly on a spread and I'll avoid taking delivery and I'll just, there's risk involved, but I took the trade on. And the trade made me a ton of money. Lucky, right? And and the floor was still there. And so my broker, very good friend of mine, he's a founder. He's a friend of mine now. We used to be competitive. He was a broker and I was a trader, so we'd fight all the time, frenemies. But I call him up. I go, his name's Joe. I go, a different Joe. His name is Spin, right? I call him up and I'd say, dude, why am I making so much money on this trade? This doesn't make sense. I'm supposed to make $5, $5 a month. I go, but I'm making $10 a day now. And he's like, some guys are screwed. Then I go, who? And he goes, I think a bullion bank is in need of metal and doesn't have it. I go, well, what would I'm asking, what would I look for? I wasn't that sophisticated on leases yet. He goes, well, the leases are trading here, not there. And I go, well, why is it that when I ask for you guys, how many times have you heard this? Why is it that I ask for a market on this spread? It comes in where I think it is, but it always settles 20 cents out of whack. And he said that's because the locals are about to blow out. Now you can look it up. There's a guy named Danny Shack, Shak. Danny Shack was the biggest spread trader. He's actually a poker player now. You can actually see him on like live poker matches, World Series of Poker. Um, he had the biggest spread position, and he got taken out on a stretcher, completely taken out. Like we're talking millions and millions. He'd been doing it for like 20 years. It was like a hand-me-down business from his father. Massive. He would have a spread position. This is an individual with a spread position going out 5 years. So buying and selling all along as a market maker, but lopsidedly long the backs and short the fronts. And this is what happened. Um, it didn't happen on one night, but I saw it. I saw it one night where the future spreads in silver were here. Here's your spot, and there's the future spread 2 years out. And Danny Shack and the other guys were long this future. I could be wrong, but I don't think I am. We're long this future and short the shorter dated futures. And the next day we came in, the futures were like this. The market hadn't moved, but the futures were like this. I'm like, what the hell's going on? So I called John. What the hell's going on? He goes, one of the banks said they had enough. It's like the way way he put it to me. He goes, one of them, I knew he was talking about JP Morgan, right? I think he was anyway. He goes, one of the banks said they had enough and they decided to get out. And so they pushed it against themselves in liquidating. And then the market ran because they had covered their position. And that's when Danny Shack got taken out. Now, the reason I'm bringing that up is because that's an example, Scott, of JP Morgan being too big for its britches, still having all the information flow and getting out just in time. You follow me?
Yeah, I do. I do.
Right. So it could be both. It could be JP Morgan starting to spread their pain elsewhere. You know what I mean? I agree with you, especially since the SLV custodian vault is there. Now I'm going to give you another example. It's not that example, but it's natural gas. Uh, those of you old enough to remember, which is probably a lot of you looking at our group here, in 2001, whenever the Enron crisis happened, whenever Enron went under, it was right around the time that the government deregulated natural gas energy. So natural gas was regulated, and you couldn't raise the price at it. And the electricity generated from it, et cetera, et cetera. And so Enron started their whole game. Enron's like, they deregulated the price of natural gas so it could go up, but the electricity in California was still fixed at a price. And so Enron and El Paso and all the other guys started pushing natural gas up and breaking California. This happened. You can look that up. It's like uh, the names are El Paso Energy, uh, uh, Enron Energy, Duke Power, Sempra, Chesapeake Power. These were all utilities that bought natural gas for a fixed price and sold energy for a fixed price. But when they deregulated power, when they deregulated natural gas, but not power, these utilities created trading desks separate from them. So San Diego Power in San Diego created Sempra Trading. I don't know what Sempra stands for, but they were someone I used to go head to head with. So Duke Energy created Duke Trading. Everyone created trading arms. Enron was a division of like Entergy or something like that. El Paso Trading was anyway. So these trading desks, they were separate from the utilities. The utilities used to face each other. Hey, can I borrow a cup of sugar? Yeah, sure. I'll give it to you. Get it back to me. It was a gentleman's relationship, that whole donut thing. But then the trading operations started, and the trading operations will go like this. Sempra would say to its parent company, San Diego Power, oh no, you can't do that. I want that. And so the trading desk started front running the gentleman's agreement. Oh, you need the power? I'll take it. You need the power? I'll take it. And the whole natural gas system exploded. And the reason I'm telling you that story is because this is probably happening in the metals now. Somebody in the know, and so using Scott's version, somebody in the know who is panicking, like JP Morgan, is spreading the pain around. Or somebody in the know who is in control is taking a position to spread the pain around. And that's basically it. So this interdealer market that I started off talking about is extremely important. And by the way, that's where the smoking guns are hidden. Whoever has the biggest derivatives book is the problem. And you know what, Scott? Thinking about the 90% of the derivatives in the COMEX market, that doesn't just go away. I'm sure some
No,
of it expired, you know?
no,
And
it doesn't.
right, is that
And these are decade-long positions.
right,
And
right,
and
right.
and I think the BIS has tried to tidy up gold, but
Yeah,
silver has been left alone. And it's
right.
the weak point. It's the weak point for the big boys,
It is. It is.
right?
So to clarify, to put a little fine point on what Scott's saying.
And sorry, one more point. JP
Yeah,
Morgan's smart, but the London whale was also there.
exactly.
Achilles
I was going to say
macris,
that.
right?
Jamie
Achilles
Dimon,
macris. Yeah.
exactly. I mean, look, JP Morgan's very smart, and they always and they tend to at the extremes expect JP Morgan knows that they're systemically important and they'll get bailed out. So they wait to the very last minute to get out of trades. That's right. So JP Morgan could be the bank that's screwing up. Um, so what I meant by the 90% of derivatives don't just go away, some of them expire, but what ends up happening is they have to clean up their publicly known book. So they clean up the COMEX and they just put it. Look, anytime a company's having a hard time, what do? They create another subdivision. They put all the bad shit in it, right? The bank that has the bad bank, the spinoff. I'm a company and my company's doing really poorly because of one bank. So I spin off the good part. They spin off the portfolio that sucks. We used to call it black boxing. Like when I had a position that wasn't working, that was really screwing up my position, I would take it and put it in another portfolio and say, it's a black box. I don't want to see it for a month because it would screw me up. Anyway, there's a really good chance that JP Morgan and perhaps Citibank, mostly JP Morgan, uh, and maybe HSBC and maybe Bank of America, they took their derivatives position and they black boxed it. And it's getting too big to ignore. You can hide a lot of shit. Silver's not a big market. You can hide, you know, billions of dollars on JP Morgan's balance sheet. You just can't hide billions of
So,
silver
so,
that you don't have.
so can I throw something different in there? I mean,
Yeah,
we're not talking about the Hunt brothers. We're not talking about Soros. We're not talking about Buffett. We're
right,
talking about China, which has systematically been going throughout the world, taking concentrate, taking silver from wherever it can find it.
right,
India as well. These are very, very big players, right?
right, right, right.
And
To that point, directly speaking directly to that point, it's JP Morgan versus the PBOC. You're talking about China. You're talking about the CCP telling the PBOC we want to buy all this. We want the price down, but don't. There's the only look. JP Morgan is an extension of the BIS, which is an extension really of the Fed. The Fed is fighting the PBOC in metals. That's what's going on, and that's why I call it a prisoner's dilemma. So
yeah,
yeah,
can I nuance that?
yeah, sure,
JP Morgan is basically the Fed, okay,
yeah,
because it runs, the biggest reserve position, all that sort of stuff. I think the BIS is changing. I think the BIS is floating around trying to find out who's going to win.
yeah,
Yeah.
yeah, yeah, yeah. Let me talk about that. There's a book. Um, it's not the greatest read in the world, but it's semi eye-opening. Let me find it. Here it is. The Tower of Basel. Now, if I have a copy of this on my PDFs, I'll give it to you. What a stupid blurring thing. Wait, how about if I go here? There you go. Tower of Basel. All right. So it's not an exciting read, but what I got out of it when I read it was because I was biased anti-bullion bank and I was biased anti-BIS. What I walked away from that book was, oh, they don't give a shit. They just want to make money. To your point, Scott,
That's
they
right.
play. Right, right. I mean, but that's my own. Right.
In some ways, that's worse, right? But anyway.
Oh, it is worse. I mean,
yeah,
like it starts like there's a chapter in here. Oh, they didn't give a shit. They took the Nazi gold.
yeah,
They
yeah.
didn't
That's
care.
right.
Like they
That's
didn't
right.
care. They had like the dead Jewish people's art. They didn't give a shit about that. Um, and I walked away from it as a person who was pronouncedly biased against the bullion banks, but respected them. To realize that the BIS itself, this is when I started studying bureaucracies. The BIS itself is just a big bureaucracy that wants to stay in business. And all they care about is the money. So for decades, as an extension of the Fed, right? And as an extension of a world that was going neo Keynesian and needed to support bonds and demote gold, and you had Greenspan saying, here, you could sell gold. You had the market structure saying, well, it's a tier three asset. And I'm sitting at the BIS as the head trader at the BIS, and I go, let's see, gold's a tier three asset, bonds are a tier one asset. Idiots still buy gold. Screw it, sell it. Gold wasn't money anymore. And they were collecting gold from third world countries and hedging it and giving them money. And I mean, it was just a market that was long gold and silver, especially silver actually, that needed cash. So they would take gold and hedge it. So the BIS was making money doing that, trading it from the short side. Now we talk about what Scott's talking about. The world's different. In that culture I just described, all the banks went out and they centralized the selling. Give me all the producers selling. I want all the producers because the buyers are fragmented. Now the buyer is bigger than all the producers. And the BIS, which wants to survive, is saying, okay, you have to go where the money is. And the money is now in China, at least partly. Now, I want to give you a couple pieces of information that are actually observational information that's actually corroborates what you said, Scott. And that is 5 years ago, the World Gold Council would say things like, let's say gold makes a new all time high 5 years ago. The headline will be gold looks toppy, gold makes a new high, new all time high. And about 3 years ago, 2 years ago, really, about the time that HSBC pulled out of the US and started creating blockchain products, the World Gold Council started putting out different types of reports. And the reports were get the report. It was like unbelievably pro gold. It was get ready, gold's going to be a new asset. And then they said the World Gold Council put out a report saying Europe should own gold, not bonds. I said that to you a long time ago. And then they did it for Switzerland. So Swiss should own gold, not bonds. And I, what the hell's going on here? And then they did it for Ireland. The Irish, stupid little like country in terms of finance, right? But the Irish should own gold, not bonds. And I'm like, what the hell's going on here? Why are they doing this? And I talked to a friend of mine, business colleague of mine, who who is connected on the propaganda side. He goes, "Oh, the World Gold Council is taking money from the Chinese now." And around that time, I started seeing Bloomberg put more stories from Singapore in the US feed. Scott, right? So I look at the World Gold Council and I say, "Oh, they want to stay in business, and China's now paying their salary." And I went, "All right." So the bullion banks that are still thinking it's going to be bearish are missing out. So I think my point is the BIS is going where the money is, right?
Agreed.
I mean, they have to honor two gods. Okay, let's move on from that. I love that.
Thank you, Vin.
Yeah, sure. Julian, what's the real risk here in respect of market and bank impact? Insolvent banks, price spikes, liquidity disappears. Um, well, the real risk of what's going on now, I don't. Generally speaking, when I look at risk, I look at the worst case scenario and work my way in, which is very good for risk management, but very bad for sleep. So the real risk is, this is going to sound crazy, but the real risk is as a trader who trades, not as an investor, right? As a person who's going to have a position all the time, the real risk is that you wake up one day and the COMEX says no more deliveries, and SLV says no more intake. What's happening in India right now is that India will not take clients because they don't have enough silver. So could that happen in the US? Yes, but that's the most important thing to the US. We must not shut markets down. I was at the NYMEX when the World Trade Center happened. I mean, I was there. I saw the whole thing. Uh, I have never seen a bunch of raw, myself included, capitalists get so patriotic because the word started coming out to all of us individually. We're going to open in 2 days. We're not going, like, we came back the next Monday. We're not going to let them shut us down. I'm like, what? People are fucking dying here. But I got into it too. And the point was, I got into the concept that the United States must be the price projector for oil and gold and everything else because we had to let them know that they wouldn't win. They blew up the World Trade Center, but we'd still operate. And that stuck with me, that moment. And I recognized that the US, if the US were to ever sever gold deliverability or silver deliverability from a contract, you would destroy your franchise and you would take a leg out from the dollar support. Anyway, so all these other countries it's going to happen with before it'll happen to us. So that's the worst case scenario. All right. Working in from the worst case scenario, it's 5 margin raises. Okay. Who was that? Julian who asked me that? The first thing that an institution does to protect itself is it does what it always does, too much. So we've had what, 2 margin raises in silver, right? If we get 3 more margin raises and silver keeps going up, that's a problem. Then you got to say, what are they going to do next? And what they're going to do next is you might see a force majeure type of thing where they step in and they permit something they shouldn't permit. You'll see an interregulatory easement. What do I mean by that? During COVID, when there was a problem because of the refiners were out because of the lockdowns, we couldn't take our 100-ounce bars and we couldn't take the 300-ounce bars and deliver them to the US because they had to be remelted. And so for that time period, the CME, after a month of this going on, the CME had a conversation with London and they created a temporary agreement where the 300-ounce bars would be acceptable as 100-ounce bars in the US. So basically, every three contracts pulled one. And they fixed that for a short period of time. And then the CME created a futures contract that did a 3-for-1 swap. And so that solved the problem. And then the contract died. So if you're looking at the risk here, it goes raise the margins a lot, make an announcement, we're going to make something simpler. And the last thing you'll hear is, and there'll be other things between here and severance, but I would say if you're looking for early indications, keep an eye on India. If India doesn't uh, come back online soon, that's a problem. So there's a progression. It won't be overnight, but it will be. But it will be bad. I mean, I don't know. I don't know if I'm helping you that much, but yeah. Um, Alan Dulles from former. Oh yeah, you read it. Meaning you read the book, Presley. All right. So two so far. So nickel, yeah, nickel, Scotty, right. What happens if somebody options in force majeure also paid at the current value? Well, what do you mean, Carl, by force majeure? Like, what do you mean? You're talking about like the severance of delivery? Is that what you mean?
I'm not that familiar with the process, but I assume that if I was holding the actual SLV option or shares,
Right,
that I would get paid at the current market rate of silver. But you tell
right.
me
Oh, yeah, yeah. I see. So reframing your question or your concept, what would happen to the profit potential of SLV if they severed deliverability or made it physical, made it cash only? Is that what you're asking?
exactly, and you know exactly what would happen if you were holding actual shares versus options.
Okay, so there are multiple things that can happen, but they're all within, they're all in a constellation. The first thing is when you sever deliverability on a contract, um, sometimes it continues to trade with it because it's not a big deal. Other times it'll just go to zero. It'll just be abandoned. Maybe not overnight, but it will slowly lose its importance. Um, an example of that would be, are you familiar with the equity side, Carl?
Much, yeah.
I'm sorry?
Yes.
Okay. Are you familiar with what a closed-end fund is?
Oh,
I didn't hear
can you
you.
hear me? I know I'm not.
Okay. I'm not going to get into details. You can look it up on ChatGPT, but a closed-end fund is typically closed-end funds in the US used to be very popular for municipal bonds. And a closed-end fund means there's a limited amount of shares. And what ends up happening is the bonds are worth, let's say, 500,000.